Are you interested in real estate but stuck in analysis paralysis mode? I totally get it. We were there too. There were spreadsheets which were okay, but we were never looking at just one property. Often we were evaluating multiple at the same time and trying to see if even one of those properties fit our criteria. We created Simple Wealth to help you easily research and evaluate rental properties. Simple Wealth runs calculations using well-documented formulas that we explain to you. It also brings in research like the last purchase price of the property and recent tax data. There are even sexy graphs for things like your total return over time. It's time to ditch your spreadsheets and let us do the math. Sign up for your free trial at simplewealth.co/podcast. This year marks the 10th anniversary of the Men's Wearhouse National Suit Drive. Donate your gently used professional attire at any Men's Wearhouse store from July 1st through July 31st. They are collecting all kinds of professional items, including sports coats, slacks, dress shirts, sportswear, outerwear, and other accessories as well. Visit www.menswearhouse.com/national-suit-drive for more information. Those who donate will receive a thank you coupon for 50% off regular priced items, or you could text NSD to 66960 to receive a $10 off your purchase of $50 or more. The Men's Wearhouse National Suit Drive. Give a suit, change a life.
Hey, what is going on, everybody, and welcome to Listen Money Matters. The safest way to double your money is to fold it over and put it in your pocket. My name is Thomas, and I'm here, as always, with my good friend Andrew. Andrew, how are you, and what are you drinking? Is it 4 o'clock for you?
Yeah. So it's actually more appropriate that I'm drinking beer now. Usually I'm starting at 9, and then when we're done recording at 10, I just don't do anything for the rest of the day. But
yeah, so now that it's 4 o'clock, you're going to hold up a handle of absinthe, right?
Damn right. Just drinking some Great Lakes Brewing Co. Turntable Pills.
Okay. Is that from Minnesota? Or maybe not. Wait, no, actually, Great Lakes. So maybe like Ohio or Michigan or something?
Oh my God, you're asking me all these challenging... Yeah, it's Cleveland.
Oh, nice. Nailed it. I'm just drinking coffee because that's the kind of day this is. But it's in a glass mug, which is just the best.
It looks very fancy.
I know, right? Somebody on Twitter was like, "Oh, do you have like some brand name?" And I looked at it; it was like $32, and mine was like $6. So either they got screwed over royally, or my mug is going to break very soon. We're gonna find out.
The only thing I can get in New York for $6 is a punch in the face.
Yeah.
That does sound about right for New York. Craig, does that sound about right?
That's about right.
You know, I gotta say though, like I don't know what your guys' opinion of New Yorkers are, but when I went there the first time, somebody told me that like New Yorkers aren't mean; they're just on a mission, and like you're in their way for their mission, and that's basically how I've perceived it ever since. They don't want to run you over with their car; you're just in the way of their mission, which is to get dollar pizza or something.
Well,
anyway.
I was listening to Freakonomics, and the episode was called "How to Get Away with Murder," and the only or the best way to get away with murder is in New York hitting someone with your car because there's no vehicular manslaughter. And actually, Craig, you're a police officer, so you can tell me if that's correct or not, or you were a police officer.
I think there is vehicular manslaughter.
So, okay, don't kill somebody with your car. Always dishing out that solid life advice.
It's been about 17 years, but I'm pretty sure that one's still on the books.
That sounds kind of like one time somebody said, "Oh, if there's a white border around a stop sign, you don't actually have to stop." And I'm like, it still says stop.
That's painter's tape.
Why would that make any sense? So anyway, we've already kind of introduced Craig, but guys, today on the show, we have Craig Cody, who is a certified tax coach, CPA, and former New York City police officer, which is why he knows, unlike Andrew, that you aren't allowed to kill somebody with your car. And he also knows quite a bit about taxes. And so today we're going to be talking about taxation and how it relates to real estate investing, which I know is something that Andrew is probably chomping at the bit to learn more about since, what are you up to now? 4 properties? 3 still? 3 still? Okay.
I live in one, and then 3 people live in my other ones.
Gotcha. Okay. So you own 4 pieces of property. You're just
Yes.
not really making money off of one of them. One of them's your money pit.
Exactly. One is terribly expensive.
So, Craig, do you also do real estate investing too?
I have at times. Currently, I'm doing college investing.
College,
as a matter of fact, my last one graduates this weekend.
Okay, nice. So did you sell off your properties that you had then?
The last one I sold off about 7 years ago.
Okay.
And unfortunately, the first one I sold off was recently sold at about a 5-time profit in Manhattan. So it hurts when I think about it.
Yikes. That reminds me of that Victoria's Secret story from the Social Network. I don't know if you guys remember it. Apparently, the guy who started Victoria's Secret, he was just a dude, and he sold it for, some respectable amount of money. But then a few years later, it sold for many times that to a very big company, and he ended up jumping off a bridge or something like that.
What?
Yeah. I don't know the whole story, the full story, but it's in the Social Network.
Interesting. That's weird, because you'd think he'd at least get their mailers for free at home.
I guess that FOMO can be a killer.
So
anyway, get into it, Andrew.
I was going to say, Craig, to start, can you explain how rental income is taxed? There's all these things floating around, and people say, I want to hear it from somebody who actually does taxes.
Okay. So rental income after your expenses is taxed as ordinary passive, in most cases, ordinary passive income. Okay. If you're an active real estate person, then it's ordinary income.
So I'm already,
So what's the difference there?
Yeah.
Passive versus active.
Passive really comes more into play when you have losses in your real estate. So passive losses, depending on how much money you make, can only be offset against passive income.
Okay.
If you make under, let's just use $150,000, you get to take passive losses up to $25,000 a year. It's like a sliding scale.
Okay.
But the main thing is a lot of people have real estate and they have these losses they're generating, and they think they could offset all the income they're earning. And it turns out they're making too much money to be allowed to take the passive losses, so they have to figure out ways to generate passive income. And that's where tax planning comes in. Sometimes we figure out how to generate passive income.
Go on. Tell me
and
more.
then you use that passive income to offset your passive losses.
I'm confused.
That would otherwise, yes, very confusing. So it's the problem is a lot of people don't realize, and there's not enough communication between them and their professionals to realize that real estate's a wonderful investment. A lot of times it throws off losses, but if you don't really do some planning, those losses may be deferred to some point when you have other passive income.
Okay, I feel like I now have 10 question threads that I want to ask you. But to close out the first one, what is active income and what is passive income? Because if I don't do anything to get my rental property, I get that that's passive income.
Right.
But I heard that rental income isn't always passive income, or I guess what you said, sliding scale of how much you earn,
And it more often it comes into play on the loss side, because if you have passive income and no losses, you pay tax on it. Whether it's passive or non-passive income. But if it's a passive loss, you may not be able to deduct it. But if you're a real estate professional and you meet the criteria, which is basically if you have another job, you have to actually be spending more than half of your working time doing your real estate. So you may not get the option of taking those losses immediately. They just sit there.
So let's say I make $20,000 a year, because I really don't work that hard. And I have rental properties that generate losses of $20,000 a year. You're saying essentially at that point, because I'm at so low on the scale, I would pay $0 in taxes.
Correct.
Okay, now let's say I work a little bit harder and I make $80,000 a year. I mean, well, a lot harder. And I make $80,000 a year and I have $20,000 in passive losses. How would you calculate that?
You would probably at that point still be allowed to take those passive losses.
So that means
would that mean your net income would be, or your net taxable income would be $60,000?
Yeah, if we just look at it real generally, yes.
Well, let's not get super specific because I know there's like an edge case for every state or whatever. It's ridiculous. But so in a broad sense, but however, if I worked really, really hard and never slept or talked to anybody and made $300,000 a year, and I had $20,000 in real estate losses, what you're saying is I would be so far above in the scale that I would essentially be able to deduct nothing against my income.
Well, you would deduct you'd have your income from your real estate and you'd deduct your expenses from there. But then if there was excess expenses, they would not move to your personal return or to the page one of your returns where it would offset your other income.
Okay, so what we're saying is there's like, you can think of your real estate investing as a bucket, and if you have a net loss in that bucket, more losses than profits from your renters, then those are your passive losses, and we're talking about how it affects the rest of your income, correct?
Correct, and that's the reason why I'm a big proponent of planning.
Mm-hmm.
So if you look and you do planning, you could figure out, okay, do I fall into that? Am I not going to have these deductions? And if I do, is there a way I could plan that we can create some passive income?
So I want to go there, but one more question before we go there. Let's say that I'm making $300,000 or whatever it is above the threshold where I can't deduct my losses against my income. Do those losses just disappear and it's just like a lost opportunity? Do I got to pass them on to my mom? Like
they sit there, okay, until you actually get to use them. So it's kind of like you wind up with your own personal balance sheet with these passive losses sitting there on your return.
So I could do it for years and accumulate literally hundreds of thousands of dollars in losses.
Correct. And then sell the property and then those losses free up.
Oh, so if I have a really bad year, say 2013, I had no renters, I had to upkeep the property, I lost $20,000, and then I sell that property in 2017, I could claim $20,000 of losses on it against the profit I make from the sale?
Correct.
Oh, wow. Okay. Is there any sort of like limitation of years, or can you just, like, if I had losses from 1960 or something? Like,
yeah, they just stay with that. They stay with that entity.
Okay. Interesting.
Piece of real estate. So it's really important. And this is not an uncommon thing we see where people go from professional A to professional B, and professional B doesn't really take those passive losses that were sitting on their tax return and move them onto their new program, because preparer A has his own software and preparer B has his own software. So see that
people lose their losses due to like paperwork.
Oh,
correct.
Shit.
That could be an expensive mistake.
Yes, it can, and I've seen some very expensive mistakes.
So, kind of a tangent here. Do these passive losses only apply to real estate, or do they apply to something else?
Well, these what we're talking about have to do with real estate, but there are other ways to have passive activities that can generate losses.
Okay. I'm just thinking, like, right now, like, what if I have a hobby business in my garage that actually loses money for years? I know, like, eventually you're not supposed to deduct those losses from your normal income. I don't know if that falls into the same category or not.
That's kind of a little bit different.
Okay.
I wouldn't confuse it with typically it's the issue with passive losses not being deductible really have to do with real estate in more cases than not.
Gotcha.
The hobby loss rules are a little bit different.
So let's say I had a hobby where I just had a website and people just sent me money for absolutely no reason, right? And I literally took me no effort. They just sent me money. It was just completely passive. Could losses of rental properties deduct against this arbitrary website that just like sends me money?
If it was done correctly, okay?
Interesting.
If it was done correctly.
So like the Offset Andrews Real Estate Losses Kickstarter Fund.
Well, I was thinking of launching a website where people could just send me money for no reason.
Well, maybe if you had an employee that was running that website, that would probably be more along the lines.
Got you.
Interesting. Okay.
Always want to dot those I's and cross those T's.
Yeah.
Okay, so we're talking about losses of rental property, but unless like you're inducted into this like weird world of rental properties, like why would I own a rental property that loses money? That sounds really stupid. Can you enlighten everybody on how it's likely not stupid and how they're probably making money?
Sure. So there's cash flow. Let's just say you're renting it out for $20,000 a year, and you have $20,000 of interest and repairs and taxes and stuff like that. So maybe you broke even there. But now you have, let's just say, $10,000 in depreciation, which is a non-cash expense. So you didn't actually have to pay that $10,000 out because you've already bought the building. So that $10,000 brings you down to a negative 10.
Okay, so I have a mortgage on this property, and I have a tenant that's paying the mortgage, and they're also covering all the expenses. This building exists. It's not doing anything for me. It's netting zero. But because the building's just like getting older, I just like get tax credits.
You get depreciation expense, yes. So that's what normally brings people to zero.
Interesting.
Or below zero.
Below zero in terms of net income?
Correct.
Okay.
So a loss.
Gotcha.
So how do you calculate this magic depreciation?
Well, there's rules. A typical residential building is depreciated over 27 and a half years. Commercial building is typically 39 years. Then, so a lot of times people buy a rental property and they paid $300,000 for it, and they say, okay, well, the land was worth $100, so the land doesn't depreciate. So now I have another $200 to depreciate, and they deduct it by 27 and a half years. Well, they divide it by 27 and a half, and they get to deduct that every year. Now, if they did some planning, we might do a cost segregation study and say, okay, well, you have a building, and maybe we have machinery that's 10 or 15-year property, and we have landscaping that might be 10 or 15-year property, and we have kitchen cabinets that are 7 years, and we have other mechanical stuff that's 7 years and 5 years. And so now we could depreciate that stuff. Instead of doing it over 27 years, we do it over 3, 5, 7, or 15. So you get more of that depreciation expense in the early years versus spreading it out evenly.
So
you're saying that you're basically like piecing the building up into several different little categories, and then you can depreciate those categories at different rates.
Correct.
So I'd be like, hey, Cody, come join my tax team, and you get in there and you slice and dice this property into the cost of the cabinets and the doors and the floorboards and whatever, and I just get more deductions earlier on and not like 27 and a half years from now.
Correct.
Okay.
That's pretty cool, isn't it?
That's really cool. Now, my follow-up question is, what if I have like a real asshole tax guy who is not doing that now, or maybe I just didn't deduct things properly because I was doing it on my own or whatever? Could we come in at year 2 or year 7 and right the ship, or is it like a lost opportunity at that point?
Oh, it's not a lost opportunity. So that's why we come in. We have you do a cost segregation study, and on a residential building, it's not like going into a multi-million-dollar building and costing all this money. You get it done. We file a certain form, and you get to pick up all that depreciation that you should have taken, over the last 7 years, and you get it all one shot. So it's called planning. So the guy is not necessarily an asshole. He's putting the right numbers in the right boxes, and he's doing everything, but he's just not planning. And typically, there's not a lot of communication, and it just takes more communication and a little bit more time to do that kind of stuff. But it turns into dollars.
Interesting.
Let's say that, we got a 30-year property, or you're saying we could depreciate over 27 years, and I've been doing that for 5 years. So maybe I took, just to round number, $1,000 off of my net income each year for 5 years. You're saying we could go in, we could do the cost segregation study. We could figure out what's been left on the table for the past 5 years. Just saying maybe it's an extra $3,000. So this year I can take my normal 1,000 plus that extra 3,000.
Well, this year you would take whatever you should have taken in year,
Okay.
let's just quote year 7.
Yeah.
And then all that missed depreciation that you should have taken, you pick all that up in that same year.
Okay. And Andrew, you haven't even had your places for 1 year yet, though, right?
Yeah, maybe one of them is like a year and a month at this point.
Okay.
But okay, so here's the thing. So you say this like cost segregation study. I'm in New York, or almost New York, like across the river from New York. Cody, you're in New York. So what do I have to do? Pay to fly you out there so you can like?
No. No, there's actually a company that we deal with that does the study, okay? Because we're not trained in that, and it's actually reasonably priced, and they put you through a series of questions, and there's a lot of information you have to give them, and they put the study together and they stand behind the study.
So what does reasonably priced
Okay.
mean? And also, okay, so what does reasonably priced mean?
So let's just say a residential building, less than $1,000.
Okay, so if I have some
Okay.
standalone thing in Georgia, it'll be like $1,000, and they'll go into every room and they'll find like screws and all this.
No, for $1,000, they're not going to fly out to your house in Georgia, okay? But they have the software and the questionnaire for you to go through, and they have algorithms, and it works very good. We've seen it work. And based on that, they will give you a cost segregation study that can stand up to an IRS audit.
Okay, so let me make
So
this even more difficult.
There are
for
like
you.
basically models that allow them to do this without actually having to look at the physical property.
Well, yeah, because you're looking at it and you're putting in the information that they need.
Oh, okay, cool.
So
Well, Andrew, you can't do that.
well, here's the thing: is so that sounds great because I just have to fill out this questionnaire. But the property's in Georgia, and what if I've never seen it before? Like, I mean, I've seen the pictures of it on the internet.
I think you could handle it.
Okay. So I don't have to have. I don't have to like
TaskRabbit
know.
with an iPhone.
Yeah. Okay. So all right. Fair enough. I got you.
Kind of like we're having this conversation right now. We're in 3 different places.
Exactly.
That's true. You could just have somebody with a Skype and a phone and walking around the house. My question right now is, if it's $1,000, how do you do the math to make sure that's going to pay off?
Well, usually what we do is we could pop in some numbers and
Okay.
we could get a general idea what it's going to be. Okay?
Before you pay?
Exactly.
So really the people that you're hiring to do this, it's kind of a formality, and you already have an educated guess of what you're going to be able to save by doing this?
Exactly. They've done it many, many times, so they kind of standard building. They have a general idea.
Okay. And now, so explain this to me. I mean, we're depreciating faster, but we're still depreciating the same amount over the long term, right? So where do the savings lie in that structure?
Up front. So up front, you get more deductions up front and less on the back end. So let's just say, you take that money that you save in year 1 through 5 and you put it in the bank.
Okay.
When you get to year 25, you'll have a lot more money than you did if you didn't take that money.
So really the concept here is lower your income now by taking a higher depreciation, invest the money you save, and you're investing more sooner, so you'll have better compound returns over the long run, which should offset the fewer amount of dollars you can depreciate later on.
Right. I mean, it's basically you're taking that money that you would not have had, and you're using it and typically people in real estate buy more real estate.
Okay.
So they use that cash flow to do other things.
Gotcha.
Or if you want to exit a property, this could count against the profits and stuff. So you don't have to wait 30 years to,
Well, it doesn't. When you sell a property, you have to recapture that depreciation. Okay.
What does that mean?
So go on.
So when you sell a property, all right, and you've depreciated that property, so let's just say I pay $100,000 for a building, and every year, just let's make it simple, I depreciate $10,000. So after 5 years, my basis in that property is $50,000. If I sell it for $150,000, now I have $100,000 gain instead of a $50,000, because I took that money, I depreciated it, and I took that expense.
Interesting. So essentially, you should ideally not sell rental properties until like 30 years or something.
Well, you'll have depreciation down the road, but you have to just kind of look at the economics of the deal.
So
does it make sense?
if we were working together, I'd be like, Cody, can I sell this? And you'd run some analysis and you'd tell me the cost, essentially.
Correct. We'd be able to figure, okay, this is what the tax liability is going to be, and then maybe you're going to do it. Maybe you're going to do a 1031 exchange, so there is no tax liability.
What is that?
Right?
Well, yeah, what's that?
Okay. 1031 is a tax-free exchange of, we'll call it real estate. So I sell building A, I have $150,000 profit, but I don't want to pay tax on that because I'm buying building B. So I take all that money and I'm rolling it into building B. So what I use is an independent person, okay, which is like an agent, okay? I never get the money. I have approximately 45 days from the time I sell the building to identify 3 other buildings that I want to buy, and I have to close on one of those buildings in 6 months. And it's a tax-free, I don't pay tax on the sale.
Oh, wow. Man, I wish there was something like that for stocks.
It's called IRAs and 401ks.
So, Cody,
oh, wait, so if, actually that, I mean, just tangent here, but so if I've got money in an IRA and it's invested in one fund, I can move it to a different fund without paying taxes?
Yes.
within the IRA.
Oh, man.
But, okay, Cody, so you could have this property and you can milk it of all the deductions. You could like front load it because the cabinets are blah, 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 all these things, and then exit it into potentially a bigger, more expensive property and pay nothing as a result. You basically sucked all the juice out of it, and then you just move on to the next one and you continue that.
Well, you can't suck the juice again out of the next property.
Well, can't you depreciate this new property?
No, but because your basis is still what it used to be in your old property. So let's just say you've sucked it all out and your basis is down to zero. But you paid $150 for it and you're selling it for $1 million.
Right.
And you're going out and let's just say, to keep it simple, we're going to buy another building for $1 million.
Okay.
Right. So normally you'd pay tax on $1 million.
Right.
So you're going to lose, depending on where you are,
by selling
20% by selling. But instead of doing a regular sale, you do a 1031 exchange. Now you don't pay all that tax. You have this new building that's now worth $1 million, okay, or more, but you don't get to depreciate anymore because you've already depreciated it out. Now, we have a client now that had a property in California where land is expensive, and he bought 2 properties in a state where land is very inexpensive. So he's going to now have more depreciation because of the value of the land is less, so he could actually he's going to get some additional depreciation.
He'll recoup
but that's not the norm.
Right.
It's not the norm.
Interesting. So once you've basically sucked dry property one, you do this exchange, but you ideally you would never take the cash out because then you have to pay this enormous profit.
Correct.
All right. I'm still confused, which means that listeners might still be confused. So maybe let's break this down a little bit simpler because we're using things like basis points or basis things. I don't know what that means. So if I have building A and you said we paid $100,000 for it up front. Now by depreciating, are you saying that like in 5 years the building is now worth $50,000?
No, I'm saying let's just, and we're using a big number for depreciation, all right?
Yeah.
Let's just say we depreciated $10,000 a year. So when we go to sell that property, we've taken $50,000 worth of depreciation. So for tax purposes, it's like we paid $50,000 for it, not $100,000. If I keep it really, really simple.
Yeah.
So now I go to sell it. If I sold it for $150,000, I'd have approximately $100,000 gain.
Okay. Instead of a $50,000 gain.
Instead of a 50, because I've taken another $50,000 in depreciation expense. So it kind of lowers that, what we call the cost basis of that building.
Okay. And just depreciation itself, that's usually where you take the cost, you take the expense off of your taxes over time, right?
Yes.
So if I wasn't to depreciate, then I could basically say I had $100,000 loss within year one by buying that property. I mean, you probably can't do that, but that's what it would.
Yes.
But that's what it would be if you could do that.
If you could do it. Yeah.
Like if I buy a laptop for my business, it's $1,000.
You write the whole thing off. So buildings don't work that way.
You can't do it with buildings.
No.
Okay. So ideally, over the life, eventually you would depreciate the entire cost of the building, correct?
Yes.
Okay, so we're saying that we haven't depreciated the entire cost of the building. We have $50,000 left that we could eventually depreciate, and then we sell it for $150,000. So we've got $100,000 now. So we can't depreciate the rest of that 50,000 anymore at all?
No, if we did an exchange, now we would still only be able to continue depreciating that 50,000.
Okay, so you're saying only the original $50,000 that we have not exchanged or depreciated yet, that's all we can depreciate
unless you put more money into the second deal.
Okay, gotcha. I think that's where I was confused. I was like, I didn't hear that we could still depreciate the original or the leftover 50.
and that's why, anybody doing this kind of stuff should be consulting with a professional.
Yep.
Did you know that 1 in 5 tenant applicants have a relevant criminal hit? Or that TransUnion research shows that 20% of rental applications had at least one prior eviction? Find out what you don't know about your rental applicants and how to save 25% off your next tenant screening with SmartMove. Simply sign up, start screening, and you'll get reports delivered to you within minutes. There are no fees, no minimums, just pay per use. If you own a rental property or know someone who does, try SmartMove so you don't find out the hard way that a prospective tenant has an eviction risk. Go to tenantscreening.com and enter the code MONEYMATTERS and get 25% off your next screening. Don't be in the dark about your applicant's rental history. So I could imagine some like property in Manhattan starting at 150 and at X time ending at $1 million, or like some insane thing that is just ridiculous. I own properties in like Georgia and Indianapolis, and they're like they're increasing in value, but very, very slowly, not like New York. So, with that being said, it's would I never assess like would I'm trying to like phrase it properly, like so the exchange, the 1031 exchange, that makes a lot of sense if I've made an enormous amount of enormous amount of profit on the property based on the sale. But if over time I've just generally lost money, I might just sell it, take the cash, and buy a new one.
Right. Well, if you have a loss, then you're going to. There's no reason to do an exchange. But let's just say you only have $50,000 in profit. Do you want to pay tax on that $50,000 if you're going to buy another building or another residential property?
Well, I feel like if the property that I buy is worth $1 million, I want to depreciate $1 million and not only remaining 50.
But remember, if you
does it matter,
do
though?
the exchange, you're going to pay tax. So you're going to pay tax on, let's just say, 20% on $1 million. That's on the federal side. Okay, so you're going to lose $200,000.
Okay, so this is only if I get massive appreciation that like you would do.
No, lots of people do it when they don't have, they have $25,000 or $50,000 worth of depreciation because they're buying something else. So why should they pay tax and go back into their pocket to buy the next building when they could let the government basically finance it for them?
And bottom line, all this does is delay paying the tax, right?
Correct. So now let's
you
just
eventually pay the tax man.
Oh, no, not necessarily. Let's just say, you live to a ripe old age and you've accumulated all these buildings.
Okay.
And now, unfortunately, you get hit by the bus. So now when you die, they go to
bus or the bus?
The bus.
Should I know about this bus?
And
do you know something I don't?
Now you leave them to your kids, let's just say. So now your kids get what we call step up in basis, and we won't go into that, and they sell it the next day, they pay no tax. So you've just, beat the government out of a whole bunch of money. So
this is essentially the best way to transfer wealth to kids is through real estate because it's free.
That's one way to do it, yes. Yes. And people like real estate.
I live in a house. I like it. I mean, it's not a house. Actually, it's an apartment building, but I still like it. Okay, so to step back a little bit, you were saying, you have this like property, it's like 300,000 and 200,000 is land, or no, 200,000 is building, 100,000 is land. do you just like make that up? Like, how do you determine this?
You have to figure out what's the value of the land and what's the value of the building. So it's usually easier to figure out the value of the land, and then from that subtract out, the value of the building.
Gotcha. So big question here for the audience who is probably not dealing in $1 million buildings. At what point is the value of somebody's rental property justifiable to go pay someone to do this kind of cost segregation analysis? Because I mean, if I own, say like a $40,000 shack, does that matter? Like, if I pay $1,000 to have somebody come in and analyze it, I'm probably going to lose out. So, like, is there a certain dollar amount you think is like the right property value for this kind of thing?
I would say, at least 250 at a minimum.
Okay. So Andrew shouldn't do this.
500 is a sweet spot, but you know what? It's free to figure out whether it makes sense. That's the wonderful thing. I mean, $40,000. I'm going to tell you, it doesn't make sense.
Yeah. And I mean, that's usually the kind of real estate investing we've been talking about on this podcast, at least, Andrew, right?
Yeah.
Like, go out, buy wholesale or, not retail market houses that are, $40,000, $50,000, because that's affordable for the first time investor who's only got 10 or 15K for the down payment. So I just want to make sure that people aren't rushing out, like trying to do this crazy advanced stuff when there's not really a reason to do it at their level. Right.
And you kind of sound like a broken record, but they should definitely consult with a professional before they do anything. We don't. I got a bone saw, okay, but I wouldn't do my own, amputation. Right. I have a doctor for that. So
as long as you just heat that thing up with a blowtorch, you're good to go.
Right. I guess I feel like of all the people that I will fuck with, the IRS is like the bottom of the list. I'm deathly afraid of anything that's not like perfect with them.
Correct. And everything that we do or we recommend is basically supported by the tax code, not a gray area. It's black and white.
We were playing a game. It's called Quiplash, where there's like a prompt and then two people have to come up with the funniest word, and then everyone votes on it. So one of the prompts was like, what's the scariest thing that will come out of your toilet? And both of us put the IRS. So yeah, not the mafia, not Godzilla. It's the IRS. Scary. Have either of you ever been audited?
Mm-mm.
No.
I don't hear anything from Craig's side.
I've handled, a number of audits. Normally they come from people that, we haven't worked with, and they come to us and they have an issue, and, we handle the audit for them.
I have this feeling that it wouldn't actually be as bad as everyone thinks it's going to be, but I still don't want one.
Right. Nobody wants one. Nobody likes getting letters from the IRS. I don't like getting letters from the IRS.
Yeah.
But, it's part of doing business. It's part of, owning, properties and doing different things. And as long as you're doing it right, they can send you all the letters in the world.
Mm-hmm. Yeah. Yep.
It's when you're not doing it right and you get a letter, and, every once in a while people try and do things themselves and they don't realize it. Classic example, they bought that house for $50,000. They lived in it for 10 years. Now they turn it into a rental property and it's worth $300,000, and they start depreciating it at $300,000.
Okay, so why can't they do that?
Definitely because they didn't buy it for that.
They paid $50,000 for it, so it's based on what they paid for it.
So yeah, they can't depreciate value that they didn't actually pay out of pocket.
Correct.
It's like, hey, I bought this.
Is like the money has to actually come out of your pocket for you to depreciate it. I mean, that makes sense, but okay.
Otherwise, you could buy all these properties for $50,000, start depreciating them at $1 million, and be like, well, I'm sure somebody will buy it for that.
That sounds great. Sign me up.
Until you get the letter, it is.
Yeah. Okay, so
I got it fixed.
Stop me when this goes too far into the weeds. But there's this whole put your property in an LLC because it'll protect you legally. When the roof collapses or blah blah blah, all these things. Now, say you put the property in an LLC, and then we could debate whether this makes sense, even putting an LLC. But how complicated does that make your taxes? Whereas if I just owned it myself versus putting an LLC.
if it's in an LLC and it's what we call a single member LLC, it doesn't make your taxes any more complicated as they were.
Would you
Same
recommend?
form, most definitely, because you have that $25,000 property, all right, and you have other properties, and maybe you have a tenant that gets sick because there's some mold, all right, and you get sued, and there's a cap on mold in most states, and maybe you get sued for $150,000 and you lose. So now, as you sell each of those properties, guess what?
You owe it.
Yes.
Okay, so the LLC. So say you have this like dinky shack, like Thomas said, for like $45,000, and the roof collapses and it kills their pet lizard, and they get awarded $55,000, like more than the value of your property. You would just lose that property and as opposed to it attacking your retirement savings.
Right. I'm not an attorney, but yes.
Okay, so as long as it's single member, you said doesn't complicate your taxes.
Correct.
And does it basically operate the same as any other single member LLC that isn't related to real estate?
Yep. So most single member LLCs that are not in real estate are filed on Schedule C, your tax return. If it's real estate, it's Schedule E. So in New York State, it might cost you an extra $25 for a filing.
Okay.
So it's literally like a $25 insurance policy for not screwing over your retirement savings.
Yeah, you could call it that. But it should, and once again, it should be done with an attorney, so you do it right.
Right.
Yep. So it's really just several $100 insurance policy. But you know what? I am 100% willing to pay that. Yeah, working with an attorney. It's funny when I started in business, I was like, I can do everything myself. It'll be fine. And now it's like, no, not at all. It totally makes sense to pay those people their fair share.
Another weird question, Cody. So say we're working together and, it costs X for our work together, and it includes my personal taxes, my rental property taxes, and let's say that's it. Can I deduct your cost under my rental properties? Like they kind of fund it?
Well, the cost associated with the rental property is deducted on the rental property.
I see what you're saying. So I couldn't do the whole thing. It would have to be some proportional shared
right
thing. Okay.
But it's at least you're getting, maybe it cost you $1,000 to get the tax return done, but if you didn't have the rental property, it would only cost you $50 because you could go to H&R Block. So maybe you wind up with $950 on your rental property and $50 on Schedule A, your personal return.
Actually, okay, and I want maybe you could answer this really simple thing, because say it costs $100, and I don't know what it costs for you to do all my rental property things, but let's say it was $100 for simple math, or $100,000, whatever the number is.
Let's take the second.
$100,000. Okay, let's say it costs $100,000. Everyone is gonna be knocking your door down after this. Only $100,000. So let's say it costs $100 for you to do my rental property taxes, and we're like, well, you could depreciate that against your rental properties. Why does that matter? Like, why would I pay you $100 through the rental property angle and not just like from my bank account? Like, what's the benefit?
Well, when it's through the rental property, it's 100% deductible.
Yeah.
When it's on Schedule A, your personal return, you have a floor that you have to first meet, okay? And maybe you don't itemize, so you would not get it anyway. But, most people, the floor is typically 2% of your adjusted gross income. So if you're making $100, the first $2,000 of certain expenses, like your taxes, are not deductible.
I want you to go like even dumber for me, because you're like, well, you could just deduct it. I get that I could deduct it, but what's the benefit of deducting it? Like, what do I save?
Oh,
like,
so
is it free? I still have to pay you.
Let's just say you're between federal and state, you're in the 35% bracket. So that $1,000 that you paid to get your taxes done really only cost you $650, because if you didn't have the deduction, you'd pay $350 in tax.
So when you go out to the store and buy shit because it's 10% off, if you saw something that said like 35% off, you should like run, not walk to do it. So that's why like you should have these businesses, because you deduct things because your life is just cheaper.
If they're ordinary and necessary business expenses, yes.
I got you. Okay. So speaking about ordinary, necessary business expenses, I love to travel. And everybody talks about how, well, you like buy this rental property in Aruba and then you can like travel to Aruba for free, or you like deduct it, or what level of reality is this? Or is there even a strategy where you could do things like this and deduct travel?
Well, there is a strategy, okay? It depends on how many days you're traveling and what percentage of your travel is deductible. It also depends on what you're doing. If you're laying on the beach for the 7 days, it's not working, okay? But let's just say you're looking at rental properties every day. Then it's working.
Okay.
So you have
Is there
to
a percentage of like work versus leisure when you go on a trip like that?
There is a chart that we have, and I can't recite that verbatim, but yes. Yeah.
So basically, like, it's not like you have to be working every single day. There is some leeway where you could maybe go have some leisure time, but it has to be primarily for business purposes.
Well, it depends on the percentages and how long you're away, and maybe you'll only get to deduct 50% of the trip.
Okay.
Okay.
Okay. Now tell me how like illegal this is or whatever. But let's say that I'm going to Aruba and there's like a ton of timeshares there. And you can go to like these timeshare things and they'll give you like, I don't know, free ATV rides or something for going to them. But you're under the impression that you're going to get this timeshare and you're going to like Airbnb it or something. So you have like some crazy scheme and you're going to make money on this. And you do it for the certain percentage of time while you're on vacation. Could you deduct your vacation?
Or you could deduct a portion of it if you were there and you spent a certain amount of time looking for these timeshares. If you did the 1 hour meeting, it's not working.
So Andrew is basically asking, can I go ride ATVs and deduct that cost of the plane ticket to do that off my taxes?
No.
Nice.
You don't like those letters from the IRS, right?
No, I don't. That's why I would ask. That's why I'm asking you. Okay. But it is possible if I was legitimately, say I went to Georgia and I was looking for rental properties and I spent the appropriate amount of time, I don't know, 60%, 70%, whatever it is, and then the other remaining time I did have fun, that would be appropriate.
Right. Depending on what the chart says, yes.
No having fun, Andrew. No, no fun is allowed. Oh man. Okay. I think we've like gone through every wacky. I mean, you have more wacky scenarios than I have because I don't own any real estate properties. But and Craig, like, what are some mistakes you see real estate investors making other than not getting an appointment with a professional?
Putting it in the wrong type of entity.
Like not an LLC?
Not an LLC. Maybe they'll put it into a corporation, and maybe it's not the best type of entity to hold that property.
Okay.
Not correctly depreciating it.
Why would putting it in a corporation be less advantageous than an LLC?
Well, the one that comes up, quickest is, God forbid, you get hit by that truck or that bus.
Mm-hmm.
If it's inside of a corporation, the property itself doesn't get a step up in basis. The stock does, and typically you're not selling the stock; you're going to sell the building. So it's kind of
step up in basis. What does that mean?
Meaning, remember we talked before about when you got hit by the bus, that $1 million property. Now, if you sold it the next day, you paid no tax.
When he says basis, he means the cost of the property. So it was 50, and then 10 years later, it's 100.
Okay, interesting. So if I get hit by a bus, like, what does that have to do with not paying tax on the building?
Well, what happens is now, if you held it inside of an LLC, and it was the value of it was $1 million the day you got hit by the bus, and your heirs sold it the next day, they'd pay no tax. Where if it was inside of a corporation and they sold the property the next day, they'd have all this tax. The only way they get the step up that we talk about is by selling the stock. And typically people aren't going to buy the stock.
In a corporation that just has a building in it.
Right. They just want the building because they don't want your liability that goes along with the stock.
Okay. So you're saying that it's if I die, basically, and if the heirs sell it off.
And shit happens. You might as well do it the right way because stuff does happen.
You've heard about that bus, Thomas.
Yes, I've seen
the buses in my dreams. It's coming for me. The one evil bus. Awesome. Well, Andrew, do you have any other questions before we start wrapping this up?
Yeah, I have like one blanket thing. Do you think that there are any like key tax strategies that we didn't like touch on that real estate investors could use to lower their tax bill, or a compelling reason why, this is a tax advantaged investment?
Well, let's. I'll give you one outside the box thing that people don't realize. Let's just say they have that own that one piece of real estate property inside of a single member LLC, and maybe they have 3 kids that are probably 10 to 15 years old, and each of those kids are going to need braces, which are expensive. Mm-hmm. So if they had a single member LLC, they could set up a medical expense reimbursement plan inside that LLC and then write off those braces. So that's one outside the box thing. Yeah.
What if I needed braces?
What's the reasoning behind that?
It's because in this case, you might hire your spouse to do something for that LLC.
Okay.
And she would not get paid, but her wage would be this medical expense reimbursement plan. And basically you'd get to write off the cost of those braces, which normally you more than likely would not be able to do.
Okay, so the LLC is essentially paying for some service, but it's paying for it in the form of a medical expense reimbursement plan, which you don't have to define so granularly as like a wage. No,
it has to be reasonable compensation for whatever that person's doing. So
she can't just like go like yo-yo or something. Like there has to be some sort of work done.
Do something.
Okay.
Maybe it's driving by the property every week to make sure it's still there.
Okay.
That it's not, that the lawn's getting cut and stuff like that. You could also hire your kids to go check on it and pay them.
So Andrew, you got to send Laura to Georgia to check on the property. And then you can buy braces for free.
So if I understand this correctly, and say I made like $80,000, I could get my kids braces for 35% off and still capture the entirety of that expense as a deduction that reduces my taxable income.
Right. Well, that's why you'd get the 35% off, because you took a deduction for those braces.
That's
cool. A little bit of outside the box thinking. Yes.
Yeah.
Can you do this for yourself as well, or only for people other than you?
You could do it for anybody in your family. So you just have to hire let's just say your spouse, and then that medical expense reimbursement plan covers everybody in your family.
Say we had this medical.
But you can't hire yourself, right?
No.
Okay, because you're the partner or whatever.
You're the single member. Yes.
Yeah. Okay.
So say we had this set up. Me and my wife, and Laura's been doing all the work, and we have a child, and the medical bill for having kids is like insane, or at the hospital and whatever. Could we literally deduct that against our rental property?
If you had a medical expense reimbursement plan and you did it right, yes.
Oh my God.
Wow.
I have a lot of work to do.
I can see the wheels turning in Andrew's head right now. Sounds like a pretty good episode for you, man.
Yeah, I have
You're
a lot
in
of
a position
action
to use this stuff. Cool.
Seriously. Craig, thank you.
You might have a $100,000 client coming in.
That's okay. And I want to just let you know that I'd like to offer any of your listeners a free copy of my book, The 10 Most Expensive Tax Mistakes That Cost Business Owners Thousands.
Okay.
So we'll give you the link for your show notes.
Sweet. Yeah, that's perfect.
To be CraigCodyandCompany.com/Money Matters.
Awesome.
Nice.
We'll put that in the show notes. And if somebody wants to like lead in softly and ask you some tax question and potentially become a customer, how would they contact you?
They could go to our website, which is www.CraigCodyandCompany.com. They can call us at 516-869-4051.
All right.
Everyone
I think
in the
that
audience.
may be the first phone number that's ever been given out on this podcast.
I was going to say, I don't know if I've ever used the phone function on my phone before.
I have. I'm a call person. I usually prefer to call than text.
Most people actually just go to the site, send us an email.
Yeah, that makes sense. Cool. Well, Craig, thank you so much for coming on the show, and we will have all those links in the show notes for people to check out. So, if you're a real estate investor or if you are considering doing it in the future, this is stuff to definitely consider. I mean, even if you get your $40,000 shack, like I would probably have, like that medical expense reimbursement thing is pretty interesting.
And actually, I just want to say like that. Yes, you definitely need a tax person for doing real estate things because it's crazy complicated and there's a lot of deductions and stuff. And you could just do your own simple taxes on TurboTax, which I did. But we encourage you maybe to use some more vehicles to take advantage of deductions and stuff. And in that case, you should definitely get a tax person. Laura and I did attempt to do things like this on our own in the beginning, and we certainly paid the price in lots of IRS fines.
Oh, yeah, I remember that. And I'm really glad I have an accountant because last time I went to do my taxes, he looked at my books and he was like,
"You're fucked.
This, and this, wrong. This isn't accounts payable. This is an expense." Like I had like so many things done wrong. So yeah, hire professionals. That's the main lesson here. Anyway, Craig, thank you so much for coming on the show.
Thanks, guys, for having me.
Yeah,
Absolutely.
And everyone else, thanks for listening. If you're interested in real estate investing, then we have an amazing tool for evaluating properties and seeing, basically estimating exactly how much you would make per month based on the value of the property, the expected rent you could get, all that kind of stuff. Andrew coded it, like literally left half of his soul in it pretty much. So you can find that over at pro.listenmoneymatters.com. Check it out. It's a great tool. I'm gonna talk it up because I didn't make it. So I feel
Thanks,
like it's
man.
fine for me to talk it up.
Yeah, I have like this imposter syndrome. Like I can't talk about it.
No, it's awesome. It's seriously really cool. You can also find our other favorite money management resources for not managing rental properties, just everything in general to do with your money over at listenmoneymatters.com/toolbox. So check out that page for books, for apps, for all kinds of cool tools that you can use to manage your money better. So I think that's it. Thank you guys for listening, and we will see you in next week's episode. Later, guys.
Later, man.
Thanks, guys.
Please tell your friends about this show.
Don't forget about the 10th annual Men's Warehouse National Suit Drive happening July 1st to the 31st. Donate your gently used professional attire, including suits, slacks, dressers, ties, and more, to any Men's Warehouse store to give a man a chance to transform his life. Visit www.menswarehouse.com/national-suit-drive for more info. Don't forget the dashes. As a thank you for donating, you'll receive a 50% off coupon for regular price retail items. I get $10 off your $50 purchase when you text NSD to 66960.